afternoon, everybody. Welcome. We are live on the Entrepreneurs News Network. My name is Stephen Ness, and I'm very excited to share with you all today. My goal really in any type of educational process or presentation I do is really just to help you understand like rules of the road, or better yet, think of it how to play the game. All right. So my expertise in particular comes in through financial services, business lending, investment management. I've got over 20 some years in that area. And what we're doing is we're launching this series here at Nevada Partners called it Becoming Business Lendable. So through this process, my goal is to help as many entrepreneurs as possible learn the lending game. Let's figure out the rules. Let's define what it means to be in it. Let's identify the players, the coaches, right? And then let's play to win. And so I'm here because my personal expertise comes in helping people source money. So 20 some years in financial services, over a decade of it as a private banker, another 5 years, give or take, in direct business development. So I have helped business owners and entrepreneurs, individuals secure hundreds of millions in financing over my 20 years. So I'm speaking from an area of experience. And in particular, 2 years ago, I started a company that actively has millions of dollars in processing with multiple lenders for clients. And so what we're going to do today is I really want to take it from the lender's point of view, right? Because so many people say, hey, I'm the business, you're the bank, you got all the money, give me the money, right? And one of the most important things in any situation is stepping out and saying, let's look at it from the other person's point of view. So today we're going to start with that. And the reason we're going to start with that is because as we go through this is going to be a reoccurring series, and I want to build a strong foundation. So as we go through this, if you have questions, this is interactive. Raise your hand, jump in. We want to make sure that you get involved so you understand the foundation that we're building on today, because it'll be highly important. Particularly, shameless plug, in 2 weeks, we're going to have a lender in town that I work with regularly, and we're going to be doing classes on Monday, happy hour on Tuesday that we're paying for drinks. So come on out, even if you just want a free drink on a lender, right? And then we're doing on Wednesday, I'm actually bringing in another nonprofit, and we're going to do a process about how to actually master the application process, right? So we want to provide the education you guys need, and that's what we're here for. But before we can do that, we got to all be looking at the same page, right? So a little bit about me. My name is Stephen Ness. I'm the owner of an organization called Lyft. This is not the Lyft that everybody thinks of. I'm not here to give you a ride. What I am here to do is help you lift yourself. Lyft stands for Looking Inward for Tomorrow, because we believe that everyone has success planted inside of them. Our values are leadership, integrity, faithfulness, and tenacity. And our 4 areas that we focus on of core services are business development, business optimization, leadership development, capital engagement, and strategic partnerships. Now, today, we'll primarily be focusing on that capital engagement, right? What I really want to take you guys through is, what does a lender look at? How do they evaluate you as an organization? And then really the thought process that just because a lender said no doesn't mean you're not lendable. Sometimes you just knocked on the wrong door, right? And that's part of the lending process and understanding it as well. So quick overview of what we're going to cover today. We're going to talk about who are you and what is your company profile and how is that evaluated from the lender. We'll talk through what is the purpose, the different types. We're going to dig into the preferences, so that way you know who to go to for what, right? If you need equipment and you're a startup, there's plenty of lendability out there, right? But you can't walk into a Wells Fargo or a US bank as a brand new company looking for equipment and expect to get a positive result, right? We'll talk about some of the terms and pricing so you understand, like, hey, when they said this, what does that mean? We'll talk about what the underwriting process looks like, just so that you can understand that. And we'll open it up for a lot of questions. So the goal here is to help out. If you have any questions, even if you want to talk about particular situations, things like that, I'm here to help out with all of them, okay? So the number one thing I want you to understand, and I've created a resource that I'm sharing with everybody. I'm building out an entire teaching on this one idea, right? And this is the 5 C's of business underwriting. So when a lender looks at your business, they're looking at 5 different C's. Your character, your capacity, your collateral, your conditions, and your capital. And I apologize because I need to update my presentation. I just realized. We're going to dig into each of those slightly, but the idea of it is that if there are 5 different things that the lender focuses on, there are 3 of them that are going to be the most crucial. And that's going to be your character, which involves your credit, your capacity, which involves your income, and then your capital, which involves your assets. Now, the reason those three are the most crucial is because between those three, if you have at least one of them that is really strong, like really strong personal credit, or really strong business income, or really strong personal income, or a good chunk of change sitting in the bank, any one of those things can potentially be enough to get you lendable and make you funded, right? Now, that's not always the case, but it is. If you have two or more, you can actually pretty much get any deal done, right? Now, the other ones that we talk about, those come into play when you're working with the lender, right? Now, I'm not going to go into great depth or detail on this one today because I've got a whole class in 2 weeks that we're teaching in here that I want to go over with you guys on that, right? So after they've taken you through these 5 C's and said, okay, what do you look like from a capacity, right? So they're saying, think of that. The lender's looking at your bit, and they're pulling your personal credit, and they're saying, okay, what is your personal credit, right? So as there's, like there was a misconception going around for a while that says, hey, you don't need to have strong personal credit in order to get business lending. There are types of business lending where that is true. But for the 99% of us, we're not going to be in a situation where we're generating that much revenue right out the gate, right? Or that we're going to be wanting to take on the terms of that lending. And what I mean by the terms of it is it's going to be hella expensive, right? So like it'll be easy to get and they don't need all this, that, and the other, but it's going to cost me all my profits. So is it worth it, right? Then they'll look at your capacity. So for capacity, you want to think of what is my capacity to repay, right? That's all the lender's looking at. They're saying, can you pay me back? With a new startup business, it's kind of difficult. So what they'll look at then is what does your personal income look like? Or maybe you have another business entity that's operating, right? Those things speak to what is your capacity, right? Collateral is exactly what it thinks of is what, in the event you failed, what could I take, right? What has value? Now, when it comes to it for businesses, there's typically really only 4 things. One is going to be like any kind of investment or asset, right? So stocks, bonds, mutual funds, cash, any kind of cash alternative, that's going to be one, right? Real estate. So whether it's personal real estate, commercial real estate, vehicles, right? As long as it's a vehicle for business uses. If it's just a personal vehicle for personal use, that's not going to be considered collateral. And then lastly, it's going to be equipment. And now here's what's really cool about equipment. All of you right now are physically touching equipment that is an asset of Nevada Partners and Promise Startups, right? That can be used as collateral, right? The desks and chairs, right? Collectively, you have tens of thousands of dollars of desks and chairs throughout this building. That's an asset of that building that could potentially be leveraged for borrowing, right? What's really cool with business is you can go further than that. Let's say you are a company like TechStart Your Business and you have customers that pay you reoccurring revenue and they've been doing it for a while. Well, now as a line item as a business, you're going to track your accounts receivable because you have a logical expectation to say, hey, I've got 20 people that pay me X dollars every month on the first of the month for the services I provide. So I know that's coming in. Or you could say, hey, I just got a really big contract and it starts in 90 days and it's worth $500,000. That's an asset that's lendable as well, right? So one of the collateral pieces that most people miss about is when your customers owe you money, right? Through a contractual agreement. So that's an important one to look at. Conditions is the one that drives everybody crazy. So conditions that's what the bank is going to ask for from you once you start the process. The problem for you and the problem for the bank is they haven't seen your documents yet. So they don't know what they're going to ask. And because you're not a lender, you don't know all the things that you need to tell them, like, oh, I have an investment property here, or, oh, I had a credit card late payment this time ago, or, oh, I have a business structure in this capacity, right? The idea is like, they don't know what's going to happen, but it's a lot of if-then statements. Like, if you have another business, then I need these documents. If you have additional income, then I need these documents. But the frustration for you as a borrower, they say, okay, here's what I need to get started. And you bust your butt. It's a list. It's a pain. It takes most of my clients like a week or 2 to get all these documents together. Then you get them together, they review them, and 2 days later, they say, great, by the way, I also need all of this, right? And so it's frustrating, but you have to remember there's going to be 3 steps through the process. We'll talk about it. So you just know what to expect, right? All All right, so that's a little bit about the C's. The next thing the lender is going to look at, so assuming they've said, okay, I feel like you have the capacity, the credit, or the collateral, based on these 5 C's, I have enough strength in 2 or 3 of them to support the rest of the deal. I want to move forward, right? Then they're going to look at it and say, what are you using this money for? One of the most important things that you want to talk about is matching credit for the appropriate use, okay? How many of you would buy a house using a credit card? Show of hands. I mean, how many of you could, right? Like, if you could, kudos to you. I ain't got a credit card with that kind of limit on it, right? But the point of it being is credit cards are meant to be used for short-term needs, right? Like credit cards are used for those variable expenses in your business world, right? So it's a revolving line of credit, meaning you can use it, pay it back, reuse it. It's revolving. So when you have a revolving type of expense, a reoccurring expense, you want to be using revolving credit if you do need credit to satisfy it. But a strong business should actually have enough cash flow to pay those revolving costs. Otherwise, you need to cut those revolving costs, right? Now, what that means is looking at the difference between when do I need a loan and when do I need a line. Now, when you need a loan, meaning, hey, I need a bunch of money now, but I can't pay it all back right away because I need to have it paid off over time. That's when we're buying fixed assets for the business or dealing with one-time expenses that are not a regular thing, right? Now, for a startup, that can be, hey, I'm going into this building and I got to do tenant improvements and it's going to cost me $100,000 to make this lease space what I need for it to be, right? So even though you don't own that property and you're renting it from someone else, you got to pay that. Now, is your business going to open up doors and immediately make $100,000? Probably not, right? So what you need, instead of having to be like, hey, now you have a big payment every month and variable interest rate, I need to take that and say, I need to know how much I'm going to be paying over a long period of time. And so they'll take that cost, amortize it out over, 10 years, for instance, when you do an SBA loan. So now you take those fixed costs or those one-time costs or those long-term costs and you put it on a long-term debt, right? And that's something that's important when you talk with your lender, because the number one thing that every business owner wants is a blank check, right? Just, I want give me a line of credit that I can use however I want and I'll just pay it back, right? That represents the most risk possible to a lender, because not only do they have risk today, they have that same repeated risk every month without ever evaluating you again. If you take out a loan, their risk is limited to however much they give you on the front end, and their risk does nothing but decrease over time. The reason that's important for you to understand: more risk, higher interest; less risk, lower interest, right? So the less risk you represent to a bank, the more likely you are to get approved and the more likely you are to have quality terms in the offer they present to you, right? And so that's why it's important to say, okay, based on what I'm doing, this is what I need, right? 90% of the people that I talk to that want a business line of credit, if you haven't been in business 2 years, you're not getting it. So just stop. Right? Or you'll get it and it's really small, right? And in order to do that, guess what? You better have phenomenal personal credit. If you don't have phenomenal personal credit, you are not getting a business line of credit, period, when you start your business, right? Because it's the highest risk thing. Now, what they'll do is they'll be like, hey, I'll give you a credit card. We'll start at $5,000 and I'll check in with you in 6 months or 12 months and see what we're doing there, right? Or you can go to the SBA, and we'll talk about that in a minute, and I'll explain to you why that's so powerful, right? But when a lender is just lending through their own balance sheet, all the risk is with them. But if they decide to bring someone else into it, then they can share some of that risk. So let's talk a little bit about the different types of loans that are out there, right? So I'm going to break it into 2 larger categories. It can break into subsets of this and industry specialists and so much more from that. But I don't want to overwhelm you guys, because I think of it like this. If I go to a mechanic, I don't need him to tell me about how internal combustion works. I need to know when I push the gas, it goes. When I push the brakes, it stops. We want to gain enough information so we can have intelligent conversations with our lenders to demonstrate our character and be able to get to success, right? And we also need to know, like, what kind of loan do I even need, right? So for our traditional loans, we have SBA. The power of the SBA is a federally funded organization called the Small Business Administration. depending on the different type of loan you do through the SBA, and we're going to break it down in a minute, the lender gets a government guarantee. So what does that look like? So you get a loan from $100,000 from bank ABC, and it's an SBA loan. If that is through their 7A program, that as soon as you close, like literally they already took it before they even closed your loan. They sent it all to the SBA, got an SBA loan number, and the SBA said, yep, we'll buy that loan. It sounds great. So the day you close on that $100,000 loan, they issue you $100,000. They go immediately to the SBA. They say, hey, you know that nice loan you like? Here it is. Buy it, please. SBA says, yep, we'll take that. Sounds great. Here's $75,000 back. So the lender themselves only has 25% risk now. So they love to go through SBA because they immediately dilute their risk on your loan. So as long as you pay back 25% of your loan at least, then they break even, right? Now, because of that government guarantee, there's a lot of steps to go through, a lot of requirements, right? So it's a very tedious process, right? So it's probably one of the harder loans to get, but it's one of the most beneficial because of the programs, the incentives that are set up to it. And this is where through the SBA 7A particular program, if you hear me talk about a crazy success story today, it's going to be through that program, right? So it's the utility belt program. Then we've got equipment finance, right? So if you need to just buy equipment, if you need to buy collateral for your business, that collateral can then help you qualify because in the event, like let's say you're buying a car, well, if you fail, they can repo the car and at least there's some value that they'll receive back. So again, reducing their risk, right? Even lesser risk, we go to things like commercial real estate. So now we talk, not only is there an asset behind this deal, there's an asset that can't move, right? With a car, with your, with any of the equipment for your business, it can, get up and mysteriously disappear. As of yet, we ain't seeing any houses move, right? Or we ain't seeing, the commercial buildings be moved. So that presents the lowest risk. And therefore, that'll give you some of the best terms as well. Also, looking at other lower risk types, look the difference between like a bank and a credit union, right? So when you look at a bank, they have shareholders that require returns. They're managed by a board of directors and things are set from very, very high levels. They are there to serve that board of directors and enrich their shareholders as much as possible, which comes at the expense of their customers, right? That's how our corporations work. With a credit union, it is owned by the credit union members. So for instance, we have a local credit union called Clark County Credit Union, CCCU. And last year, their profits were like 5-6 million. So they took that out depending on how you were a member and what they scaled. And they literally paid a dividend to everybody that banks with them, right? So the reason I mentioned that is credit unions typically will be a little more stringent. They're particular. They like what they like and they do what they do. So if you're not going to fit in their box, you'll be wasting your time. But have a conversation with them because fees are going to be lesser, interest rates are going to be lower, but processes tend to be a little bit stringent, or you don't get to go outside of the box with a credit union, right? And then you have specialty lending, right? So specialty lending could be like, I'm a doctor and I want practice fine, and there's lending just to special doctors. Or we work with a lot of NFL players in one of our other entities, and so there's a lender that we work with that does lending just for NFL players, and it's special around their contracts, right? There is specialty lending all over the place, but it's usually going to be particular towards higher level niches or just things that come in a lot, right? Like, for instance, financing in car dealerships. You can get an SBA loan to buy everything except the cars. You can't buy, because if you are a car dealership, when you buy that car, it's not equipment for you, it's actual inventory that you sell, right? And so it just works out a lot differently. So an entire different finance sector is grown and operating now called flooring financing. So flooring financing provides financing for dealerships of the vehicles while they sit on the lot until they sell them, right? Because SBA couldn't satisfy it, banks didn't want to take the risk. So a specialty lending came up. Now, what's really cool about alternate lending is these weren't necessarily born out of necessities. These alternate lending was born out of injustice, right? So a CDFI is a community development financial institution. It was born out of the CRA, or the Community Reinvestment Act, that happened many, many years ago, right? And in essence, it's tied to redlining, if you're familiar, right? So when you look at how the country was set up and when banks started lending, they started putting red lines around zip codes that they just didn't want to put their money in because of property values, all these other things, right? And it really was a segregation, like, hey, there's people of a certain race, color, or gender there that we don't want to lend to. So we're going to redline that, right? Well, when you put that over a process of 50, 60 years, you now have lending institutions instructions that have regulations and laws within them that says, so this zip code, yes, that zip code, no, right? And then you had all these banks that say, cool, well, I have all this data, so I just won't build a branch here, or I won't set up there. So the Community Reinvestment Act said, okay, well, bank, if you are going to put up a location in this area, you have to invest in here, you have to lend in here, and you have to serve this community here, right? Like, real talk, do you know why there's only 3 banks in the historic West Side? Because if you open up a branch here, you're required to make a certain amount of investment in this community. And the sad news is they don't see the ROI. They say, hey, I'm not going to get enough people to borrow enough money or deposit enough money for me to get a return on my investment. So the federal government stepped in and said, that's not cool. You can't do that. CRA's out. So then CDFIs popped up because the banks still said, yeah, that's cool. We got lobbyers. We're still not going to lend out there. You notice they're still not here. But what we do have is we have access capital. What we do have is we have other organizations called CDFIs, Community Development Financial Institutions. So big banks give CDFIs millions of dollars every year to satisfy their CRA requirement, which is legally required. Those CDFI lenders then go out and make the loans that the big banks don't want to make. Most of my success has happened with the CDFI that's been around for 40 years, right? Like, I wish Access Capital had started 10, 20 years ago. But you know what the fact of the matter is? In Nevada, we have some of the worst lending structure out of all the other states. Most other states of our size and demographic have 10 to 12 CDFIs that are local, homegrown. Access CDFI is the first one ever trying to do it from Vegas. And the other 4 that are working here service here, but don't actually have a location here. So I've connected a lot of my clients with a lender that's a nonprofit CDFI, right? So they're not even a bank. They're a nonprofit organization, right? Their goal is to lend to women, veteran, and minorities. So you see the second line there, you have mission-based lenders. So there are lenders out there that are like, hey, we only lend to churches. We only lend to franchises. We only lend to coaches doing leadership development. We only lend to nonprofits, right? Like, there's so many different things that as a lender, hey, I only focus on these different things, right? Some of the other alternate lending we've seen, which is really, really dried up, is projection-based. So before COVID, there was still at least some type of decent market on projection-based lending. A lot of the lenders that we used to work with in that capacity have tightened up since then. One of them became a bank, and then that just, we couldn't work with them as much as we used to because they were more stringent, right? But projection-based lending is out there still. It's just a little bit more difficult, but that's another alternate lending. Debt financing or revenue financing. So this is where you get into more of that high risk area. So I put it down there at the last because it should be a last resort. You'll hear it called an MCA, a merchant cash advance, or anytime a lender says, all I need is your last 3 months bank statements, they're about to drop a high risk lending option on you. And that high risk lending option is going to be very expensive. Most entrepreneurs I work with, you're running factor rates of those things of anywhere from 30 to 45%. So if your profit margin is not greater than 30 to 45%, you cannot afford high risk lending, even if you have no other options, right? It's a very bad, dangerous game. We prefer to stay out of that space. I have had a few clients that we've done some deals in there because it was a last option and their profit margins made sense. But for most businesses, once you get on that train, it's like getting on a payday loan. There's no getting off, and they're the only ones profiting off of it. So all of that just to figure out, okay, this is the type of loan I want to get, right? And then you have to go, okay, so now which lender do I need to go with? So here's a good example. We just got a really great referral. Like, I love the people in my community. Someone wants a $70 million loan. That's awesome. Way too big for SBA. It's too big for half of the lenders in my network. And I already know that. But a good friend of mine said, hey, what about this local bank? And that's a local bank I'm not going to say because, 70 million is big to a lot of people, and they don't realize that there's only like 7, 8 banks in town that even have the balance sheet to handle that loan, right? So like you can't just go and be like, hey, I want to go talk to this person, that person. You need to know what type of market share does this business have? And then more importantly, not just their market share, but what is their plan, right? So like if it's a new bank that's recently established, a $4 million loan is huge to them, right? And so you have to think of that. Like for instance, we'll use Access Capital. When they very first started, their loan limit was 150,000. And now they've been running for a few years and they've been able to bump it up to 250,000, right? So if that's how a lender grows, and we're talking multiple years, like how much growth and how strong would you need to be to handle a $70 million loan, right? So the first question you got to ask, like, am I barking up the wrong tree, so to speak, right? Like, does my transaction fit them? So you need to know, how do they like to operate? What's the size of their organization? And then is my industry good for them, right? Now, what I mean by that is like a good example. Wells Fargo is one of the top issuers of SBAs for restaurants. So for like startup restaurants, believe it or not, they're a big bank that loves doing restaurants, startup like that. First Citizens won't touch a restaurant. They're just like, sorry, we don't like them. We don't do restaurants, right? And so a lot of times you could find yourself going to a lender because someone told you to go to them. You don't ask enough questions about, am I the right business for you? Am I also then in the right life cycle of my business for you, right? Secondly, you got to ask the lender about, what is your mission, right? So again, Access Capital, they're here for women, minorities in particular, right? So when you say, hey, women and minorities, okay, so if I fit that, I fit their mission. So that's good, right? The one I work with, it's women, veteran, and minorities. So they'll lend outside of that. But if your deal is like, oh, it's a little bit on the line, and then you're like, oh, by the way, I'm a veteran and I serve minorities. They're like, awesome. By the way, we're a nonprofit, so we could go ahead and make some notes on this that, oh, we can make an exception over this one because you're within our mission base, right? And so that's why it's important to talk to the lenders and say, hey, what type of life cycle should a business be in for you? How many years of business do you want for your average business that you lend to? What type of industry should they be in? What type of revenues should I have here, right? Do you actively lend to this industry, right? And then the other thing is make sure they have the product that you need. So I had a time, again, with another local bank that they told us they had a certain SBA product, but they were cramming us in a different one and not telling us that. And for an average person, had my client not hired me, they would have taken that product. And then when they went to do their next credit transaction in 60 days, would have got kicked in the face and would have exploded and been nuts, right? Because there's this little rule in SBA that says after you get an SBA product, if you have it of this one, you can only have one. So you need another business entity, or we have to refinance it. And there's other rules that make it really hard to refinance this type of loan, right? And so when we were doing it, we had to explain to them, like, listen, you told us you had this product. I came to you and said, do you have this product? And you said yes. And now I am about to sign loan docs, and it's this product, not that product. And we're going to get one of those as soon as we're done here, right? And so now you're handicapping our growth plan, right? And so we ended up having to back out of that deal and go with someone else. But the point of it being is, you need more than money from your lender. You need someone who understands your business and is trusting in it and has experience in it. So you need to be interviewing them just as much as they're interviewing you, right? So let's say you got that application in, you got approved, you're starting to get some of the terms and the pricing, right? So some of the things you're going to hear are the terms and the conditions of it, right? So the first term you hear is term, right? Let's see how many times we can say that in a row. What that simply talks about is, how long am I repaying you for? Now, it's very important you understand the difference between term and amortization, because this can get you in trouble when your term and amortization do not match, okay? So amortization tells me how long of a period are my payments calculation being calculated over, not how long am I making those payments for, okay? And I know this sounds a little bit difficult, so I want to give you an example here. Let's say you have a $100,000 loan with a 10-year amortization and a 5-year term, okay? So my term, or the amount of time I'm going to repay, is 5 years. My payment amount is amortized over 10 years. So if my payment amount is amortized over 10 years, that means in order to pay my debt in full, I have to pay for 10 years. But as I just told you, my term is only 5 years. So at the end of that 5 years, my balance is not paid in full. And guess what happens? That amount becomes due. Or you maybe have to refinance. It depends. Guess what we got to do? We got to read the terms and the conditions of your loan agreement to find out what are your options at that point. So when your term and your amortization don't match, you can result in a balloon payment. Now, when purchasing commercial real estate, this is very common, and most transactions don't have a term and amortization that match, because nobody wants to pay off a commercial building in 10 years, right? It's a huge payment to pay off a $4 million commercial building in 10 years. You want to amortize it over 25 years, right? You know what the bank doesn't want to do? They don't want to fix your interest rate for that 25 years. Because if interest rates go up or down, they have risk both ways, right? And we're experiencing that today because look at all those mortgages and all those business loans that were made when interest rates were really low, right? All those loans are still on the books today. The problem why banks are tightening up is the average life of a mortgage before the interest rate crunch we were in was 7 years. So a mortgage would be refinanced almost every 7 years, right? So nobody was carrying them till the life of it. So because of that, with mortgages refinancing, they're actively putting new mortgages on the books at the higher interest rate, which that's their income, right? All the bank's assets are stuck earning income at 3 and 4% for all those really cheap mortgages they gave out today. But the problem is the free market rate today is 5 or 6%. So those banks have hundreds of millions of dollars of paper losses on their books for assets that are performing less than market. Now, that will never be a problem unless we all decide to go withdraw our money. Society could bankrupt any bank tomorrow if we all just decided, let's all go withdraw our money from bank XYZ. You enter any bank name there, and if every customer, and not even every customer, 50% of their customers took out all their money, the bank fails tomorrow, right? So because of that cumbersome, that's why they can't take this risk. And so they're so tight on trying to give money away today. The last thing you're going to hear is stipulations. Now, stipulations are just going to be, if you want this money, you got to do this, right? That could be, hey, you have multiple businesses. This one needs to be a co-borrower, or this one needs to be a co-guarantor. This could be, hey, yeah, I'll pay off those cards, but you got to close them because I'm not going to let you have that much revolving debt if I give you this big loan. It could be, yeah, we'll do this, but you need to bring 10,000 to the table, or you need to bring 10% of whatever you want to borrow, or 25%, right? Like the stipulation is going to be, yes, I want to do it, but here's what you got to do to get it done, right? When you look at the structure of these things, lending, you're going to have to there's going to be a fee. So if you're doing conventional lending, SBA lending, you're going to pay the fee in one of two ways. Either they're going to disclose it right up on the front and you pay it, or they're going to hide it into stuff with the interest rate, right? The thing I like about SBA lending is all the lenders charge you a fee right up front. And then they give you this nice document called a letter of intent that says, I want to do your loan. Here's what it's going to cost you. And here's how I'm going to spend that money, right? So you even know, hey, the reason I'm charging you this is because I got to go pull a credit report. I got to go do a UCC filing fee. I have to do all this research on you, and it costs me money. And I don't even know if I want to give you the loan yet. So you got to pay. Right? That's just how SBA lending works, right? So you need to know, what are the fees for this process? When do those fees come in? What's it going to cost me? Generally speaking, if you want to do an SBA loan, it's going to cost you anywhere from $1,500 on the low end to $5,000 on the high end, depending on the amount. Now, if you are buying a business and there's commercial real estate, you could have much more in fees, right? Like for a client that we're going to be showcasing in 2 weeks, we just closed a $2 million loan. Her SBA fees were like $20-some thousand. But here's the cool thing about SBA. You know what? They're very kind with their fees. They'll let you roll it into the loan. So we can roll that into the loan. You don't have to come out of pocket for that, which is really great. So you got to understand that, right? The other thing you need to know is the interest rate, right? So if you come to a lender and say, oh yeah, I don't charge any fees, but it's because they're going to charge you 2% higher on the interest rate, right? At the end of the day, paying fees is cheaper in the long term than a higher interest rate, right? You go out and get $1 million loan and have a 1% interest rate difference. We're talking $10,000 a year difference, right? You're not going to pay $10,000 in fees typically, right? Unless you're with some kind of crazy high risk lender. But you want to ask them, what's the interest rate? And then another thing you'll see in pricing and fees is prepayment penalties, right? Especially with like equipment financing or with higher risk lending, their prepayment penalty it's a hidden way to do it, right? They don't have a prepayment penalty. They just front load all the interest of the contract day one, right? So what that means is, like, rather than a simple interest loan where you accrue a little bit of interest every day, you go to a high risk lender, you go to equipment finance, they're like, cool, you borrowed 40,000, day two, you owe us 60,000. Doesn't matter whether you paid me day two, doesn't matter whether you paid me after the end of 5 years when your last payment is done. So you have to understand that in some of the contracts that you go into. So understand, is there a prepayment penalty? If there isn't, how is interest calculated on this? Is this a daily accrual rate? Is this front loaded? All right. All right. So I'll tell you what, we're going to talk a little bit about the lending process, but I want to give it a pause. Does anybody have any questions about what we've gone over so far, right? We've talked about different loan types, what the lenders are looking for in some of the terms. Now I want to talk a little bit about the process, but are there any questions first? Fire away.
We may or may not go with this.
Yep.
But like, I'm in the process of learning about different certifications that you get in
Yep.
different companies. Does that aid you when it comes to the lending process?
So it can help when it comes to character, and it can help when it comes to your business planning. Like if you're doing projection basis, or like, because a lot of times when people do projection basis, everyone thinks, well, you give me the money and that's the catapult, right? I just need the money to make it happen. No. Like if you just need the money, A, your plan has failed, respectfully. And then B, like you probably need something else. There's something you're missing, right? Like, so I have a great one that's this same client that we just did this big refi. They just got their MBE in March or April, right? So we said, hey, yeah, this is revenues, but on our projections, we're adding 15%. You know why? Because we made these 6 new contacts in diversity supplier. We have these 6 new potential deals. And while we've only signed 1 contract, we have these X contracts that are on here, right? And so now the lender says, that looks awesome. I love it, right? So it can help to build your story, as I tell people, and create the character behind it. Is it going to be a box check, yes or no, or something like that? No. Right? Like at the end of the day, it won't be crucial enough in their decision making to sway you one way or another. It'll help, right? Yeah, well, like especially if you're going to a contract lender, right? Because if you're going to a contract lender, like, hey, I'm a contract lender, you just got your MBE, that makes sense, right? So again, it can add that value, but it's, if anything, I could say with a contract lender, it could be a requirement. They would be one of the few lenders that would be like, hey, we don't work with anyone that doesn't have an MBE. But other than that, it's not even a question. It is a question that's asked on the SBA process, but none of the other ones, right? So if you do it, they're like, cool, we get to report it. That helps us, right? So it's like, yes, like, because as a business, like as a lender, I have to report how many loans did I make to minorities? How many did I make to women? How many did I make to veterans, right? And they have to collect that data. So yeah, I mean, the lender I work with, they're like, we'll be on a tight deal and I'll explain it. And they'll be like, question, is this mission based? He's like, why? Because I just got out of the credit meeting. We're 4% short of our goal and I have to go find 5 mission-based deals, right? And so there are times when you build those relationships that it'll help in that capacity. So it's gray area, I guess. Yes and no. Yep. Okay. All right. So let's talk a little bit about the lending process. I've got 4 areas up here, and I call these like the 4 checkpoints, meaning these are just the 4 areas, and 3 out of the 4 mean you got to give more documents. So like, just be prepared, right? So first you got a document review. If you're doing SBA lending, that means 3 years tax returns, 3 years financial statements, SBA 413, SBA 1919, financial projections, business plan, 3 months worth of bank statements, business debt schedule. That's everything I need minimum just to take you on a pre-flight. Okay. So everybody write this word down. This is crucial to know for the business lending process. Pre-flight is a term in the industry where we take your packet and we present it to lenders, and the lenders make the assumption that if they pulled your credit would be wherever they need it to approve you. And they look at everything else on the deal and they say, do I want to make this deal? Yes or no? Never go to an application for SBA lending without pre-flighting that package through your lender. Most lenders, or at least all the good lenders, will take that, they'll run it to their lending committee. If it's over certain size amounts, they'll even say, hey, this is going to take 4 or 5 days because I'm going up to my chief credit officer with your packet, right? And so I've had clients where we'll have I've had clients that they were declined 4 times before they got to me. So they've already wasted like 2-3 months, and here they are trying to open up this one in particular. They were trying to open up in Caesar's Forum. So like, you got the opportunity of a lifetime. Caesars came knocking and said, how'd you like to be in Forum Shops? You're like, oh my God, yes, right? See the contract, you're like, my God, Caesars makes more than anybody. But still an amazing opportunity. And now here you are fumbling the ball for 120 days because you can't get approved, right? So for us, the last thing we want to do with anyone is take them through a process where they can't get approved. So we collect all those documents and then we go out to a bunch of lenders. And then those lenders take 3 to 5 days max, usually review it, and they'll come back and they'll provide what's called an LOI, a letter of intent. Now, it's not an approval, but it says, hey, I looked at your deal. I ran it by my people. We like it. We want to move forward with your deal. Let's make this happen. On that, it'll say, this is my fee to move forward. Here's, it's going to be a good faith deposit, right? So that's document review. That's step 1, pre-flight. After you've done that, then you go into underwriting. So you go into the credit review. When you hit credit review, guess what? More documents. So you're like, wait a second, I just got all this stuff to you. You look at it for 3 to 5 days. You want to do this. I signed your letter and now you need more documents. Yep. Now we get into the nitty gritty. Give me your EIN letter from the IRS. Give me your articles of organization. Give me your operating agreement. Show me you have insurance on this equipment, right? Like we're getting into some of the minutia of it. And then it'll be like, hey, let's set up a phone call. Let's talk about your credit. Let's talk about your business plan. Walk me through your cash flow of operations, right? You have an interview with the lender, right? And so you go through all this process. Depending on the lender, that credit review process or that underwriting can take as short as 3 days, as long as 3 weeks, right? So there's a local or a regional bank in town that you submit an application with them and it's just like a black hole for 3 weeks and then they finally call you, right? There's another one. I submit an application with them. I get approvals within 24, 48 hours and the line of credit is booked and boarded before the end of the week, right? So it's just about what type of loan am I getting? What type of lender am I working with? That process can vary, okay? Once you're through that credit review, then you're going to get an approval, hoping you get an approval, right? Once you're approved, now you go to the compliance and the conditions review. So this is kind of one, but it's 2 different things. The reason I do 2 different things is because you have the compliance review, meaning if you're doing an SBA loan, for instance, now what is the requirements to get an SBA loan and how do I get all the documents I need to fit those? Like I had a phone call with an entrepreneur before this class today. He has 2 business entities that he just filed with the state, never got an EIN, never did anything because they're for future use, right? The problem is they exist. So if they exist and you're getting an SBA loan, I just need to document it. He's like, I don't want them associated. I don't want to touch them. I'm like, I'm going to get them explained away. I can make that happen. But you have to, because it's there, we have to explain it. So you either show me it exists and prove me those documents, or we dissolve it and then you got to refile again, right? But like those are the only options to go forward because it exists. And this is the SBA rule, right? And there's all kinds of stupid little rules like that where one day before closing, and this was when I worked at a big bank, the underwriter calls me and we're supposed to close on a brand new loan, hundreds of thousands of dollars for a startup company. And they're like, hey, I know this business has $62,000 sitting in cash in their bank account right now, but those are all cash deposits and I can't fit them through the SBA requirements. So we're $10,000 short of their cash injection. How would you feel as an entrepreneur to say, hey, that 60 grand you got in cash, that I know it's legit, but I can only account 32 of it. So if we don't get 10 more grand up, you don't get this money tomorrow, right? It goes through the roof. Luckily, I was able to work with them, log into their payroll and everything, or to their processing and identify like, okay, here's an invoice you did that day. Now let's find the cash deposit. We got to match these. Why? Because they sold work boots on construction sites. Do you think they forced their customers to pay in cash, or do you think maybe it's just the demographic of who they were dealing with, right? So you have these rules. That's kind of like the redlining thing. You have this silly rule by SBA that actually disenfranchises a certain population or individuals that are trying to work with certain areas. So we have to get through it. right? I can't change the legislation. So what I can do is I can work with you to get through the compliance, right? Then we got the conditions. The conditions are the rules that the lender gets to set up above and beyond the compliance so that they're comfortable with the transaction. That can range from anything and everything to, yep, I had one, it's like, okay, well, I know you're husband and wife owns everything and husband's not on there and all that, but yep, we want him on the loan. He needs to go guarantee this because he's your key employee. He's the one doing all the work, even though you're the one owning it. Like, no, we don't want to do that. Okay, well, your approval was contingent upon that. So if you'd like to do that, let us know. You're still approved, right? But now the borrower walks away. And I was like, dude, like you guys don't believe enough in your business that you're both going to put your name on the dotted line. So I walked away from them as a client. Because I'm like, listen, like I did exactly what you asked. I did exactly what you paid me for. And now you don't want it? And I had another one, we didn't do it because they didn't think it was okay for the lender to put a lien on the bus that they're turning into a food truck for their company. So I don't know how someone gets this, but just so you guys know, if you're buying an asset for your company and it's going to be used under the company, it has to have a lien on it if you use it for lending. That's an SBA requirement, right? But like, what's the big deal about it? If you have faith in your business, it's going to be there, right? But like, there's weird structure that comes up sometimes. So you just have to be like, understand the conditions and be like, how can I work through these? I had one that was crazy. You guys are going to hear the horror stories of it. We had 24 lenders we had to pay off. Some of these lenders are so high risk and so scrupulous, they wouldn't give us payoff letters. SBA requirements say I have to have a payoff letter because I have to know how much I'm paying. And if I'm going to make an exception to that, now I got to go through all this other stuff, because if I pay too much, then I would inadvertently be giving our client working capital instead of paying off their debt, right? Silly little things like that. We had to delay. And then the lender is like, well, we're making payments every month, but it's taking us 3 weeks to get these things. So we get a payoff letter. We're like, sorry, that's no good anymore because our payment just came out on Monday and I got the letter Wednesday, right? And it was just this crazy vicious cycle. But we managed to work with the lender and find a way to get it through and get it done, right? But like stuff like that takes an expert, and it takes a lender that's willing to work with you. So if you didn't pick a lender you didn't already interview them, see, am I part of your mission? Am I the right demographic for you? Am I in the right part of life cycle for you? That lender's not going to fight for you through the process. And there are plenty of lenders that are willing and wanting to say yes and not looking to say no. Okay. After that, then you have the closing process, right? So I bring this up because there are different life cycles of a business, or different amount of cash you need, are called cash injection or skin in the game. Okay. So if you're a brand new company, less than 2 years in operations, and you want to use the SBA program, you can be required as much as 25% cash injection. So if you want a $100,000 loan from a bank, SBA rules could require them to say, you need to show me you have $25,000 sitting in the bank to be your skin in the game, right? Now, it can be as low as 15 for startups. And once you're over that 2-year period, it can be as low as 0. So I've had clients that got 2 million with a cash injection of 0 because they've been in business for more than 2 years. They're up and operating. They have the revenues and they're using it for certain things, right? If you want to go buy into another business or do a merger acquisition, either buy into a business or buy out another business, that's a 15% cash injection, right? If you're buying an asset like real estate or equipment, it's a 10% requirement, right? So in addition to having, cash or running operations, you got to show, hey, I have enough cash to qualify for this loan that I'm requesting. So when you think about it, and I want to start a business and I need $1 million loan, if you don't have $250,000 of cash, you're not setting yourself up for success out the gate, right? What you need to do is take your plan and right size it, right? Like, I don't want to say it so bluntly, but the idea is stay in your lane, right? Like, and the idea is like, there's nothing wrong with saying, I got to start by catering a single event instead of opening a restaurant, right? You know how I started my company? I started my company with no money and nothing. And I had 2 people encourage me, and we just said, hey, we're going to do what we do. And let's just find individuals. And so we didn't invest in anything for the first year, right? Like we did the very basic minimums. We know, luckily I'm a business consultant, so I know what it takes to start up a business. So we started our business. We got our stuff. We created our credit. We did all the things we needed to establish it up. But then we didn't spend any money. We're like, we need to go generate money. Like, let's go generate revenue before we even spend any money. And, now this week we just got to hire our first executive assistant, right? So you can have that growth and things there. So just right size it for you. In addition to a cash injection, most SBA loans and most lenders are going to have a post-close liquidity. So not only do I want you to have that certain percentage to qualify for it, then how much is this monthly payment? Okay, I need you to have 6 times that sitting in the bank, because I just want to know you can make the first 6 payments out the gate. Yeah, that's a fun one to deal with, right? What if you're getting a $2 million loan and your monthly payment is $250 or it's $25,000? I think is it, right? Like, wait, so I got to have another $150K just sitting in the bank to pay you. I'm like, I'm a business. I'm going to generate revenue. That's how I'm going to pay you, right? So you got to understand this. These are conversations you have to have. Seasoning of funds, that was that cash transaction I told you about, right? So if there's a cash deposit to your business that does not directly tie to an invoice, right? So like if you're selling goods or services through your POS machine, and when you get paid cash, you're not marking cash, you need to start marking cash. Because if you're not accounting for it to account for it and you decide you want to go be lendable, that cash doesn't count, right? Unless it's been in there for more than 60 days. So when you go to get a loan like this, they're going to say, give me your last 60, 90 days worth of bank statements, and any transactions that are going to be out of the ordinary for your size. Typically it's going to be 5,000 or more, but it can be adjusted down or up based on how big your business is, right? You're going to have to start pulling copies of items and documenting where that money came from in order for the SBA or the lender to count it as business revenue. Right? Now it could be very simple where it's like for us, hey, we just got a big check. Oh yeah, that was a commission from this, or we, referred people over here, and you can explain it away and that's fine. But the money you use has to be seasoned or has to be explained where it came from. And then lastly, about the closing process, anytime you are taking cash as part of the SBA deal, you got to itemize it, right? So like if you're getting working capital, they want to say, okay, most lenders will do up to 6 months of working capital. So then you have to provide financial projections and say, hey, here's what my payroll is going to be for 6 months. Here's what my rent is going to be for next month. Here's my cost of goods for what I do. Here's what it's going to be the next month, right? And so you have to line item that and say, here's what these costs will be to justify that working capital or that cash disbursement to you. And if you can't justify it, then there are instances where they can't send it to you as cash, right? So those are some of the closing. Another thing that I didn't put on here that I'm going to update is a lot of lenders also have post-closing reporting requirements. So many SBA lenders will say every year you're required to send me your financial statements and copies of your tax returns or something of that sort. The bigger the loan, the higher that requirement. Once you're in a lending world of $2.5 million, most of the lenders require audited or certified financial statements from a certified CPA, right? So you got to keep that in mind too about some of those closing questions. So there's all kinds of different crazy things. The one thing that I want you guys to understand is like, I'm just giving you the lay of the land. As I'm sure you've probably imagined, there's like a billion different ways that you can choose your own adventure, should we say, through this to get to success, right? And so because of that, everyone's situation is unique. And I am more than happy to sit down for an hour and have a free consultation with anybody that is interested. I've created a form here and it's on the QR code up here. So you could actually scan that. That'll take you to a website. You can just input your information, answer 3 separate questions, and then I'll start a process that I can set up and schedule some time with you. If you have any questions, you can also email me, direct me. That is my cell phone number on there. You can feel free to call me, send me a text message. I am here to be a resource for anyone and everyone who is searching for capital. I am also not a gatekeeper or here to keep anyone from resources that are available. So if you are a business and you just know that there is no amount that you can pay to anybody because you can't afford it, I will still connect you with someone to if you are lendable, right? So we have 3 different ways we engage with people. One of them is free. So like, I'm not going to gatekeep. I'm not going to keep anything. Now, granted, I'm not going to do your work for you, but I will introduce you to someone after an hour consultation if I believe that they can do your deal for you, right? And that doesn't cost you anything. That's just an introduction. So I'm here to be a resource for you guys. If you need help with it, let me know. Or if you have any questions, I just kind of want to open it up for questions from the group. Fire away, my man.
So as you were finishing up and you were talking about like closing costs and stuff, know if I missed this or not, but once you get this loan, right?
Mm-hmm.
This is just my thought on it. You now have to go like right now. I'm kind of looking for funding. And I
Okay.
say kind of because I'm not looking for traditional funding
Okay.
right now. And
You thinking
once
more
you
like
take
investor,
this,
so to speak?
yeah,
Okay.
yeah. Um, but once you take this money, you kind of want to go full. You want to be hyper focused on what you're doing,
Mm-hmm.
right? Does these ways of lending do they include some type of, I guess, working capital
Mm-hmm.
for you to maintain because you got to still pay bills?
Yeah, yeah,
You know what I'm
absolutely.
saying?
Yeah.
So, is that included in this type of?
You can. Yeah.
Can you
So
repeat the question?
yeah, absolutely. So the question out there is like when it comes to this type of lending, particularly let's say like a term loan, an SBA loan, can it include working capital or stuff to support my operations, right? Because like, hey, I'm a brand new business, or let's say in your case for Editable Bunch, let's say you want to open up a retail location, right? You want, like, we want to have a restaurant, right? Yeah, there's a ton of costs that you can't pay back day one. And there's also a lot of costs that aren't going to come day one, right? Like in restaurants in particular, I'm consulting some. We're opening up more locations this year. I literally got 300 applications I'm spending time to review this afternoon, right? Like, so when you look at that, there's this whole thing that's like, okay, there's this upfront of the building and everything. But then it's like, then I got to cover payroll for 2 weeks while I train all these people. Then I got to order hundreds of thousands of dollars of food before anyone even prepares a dish, right? And so all those costs. And then you're like, oh, by the way, I got to market, I got to advertise. Yeah, those are all working capital. So that's what the SBA 7A program is perfect for. So the SBA 7A program is like a utility belt. I've gotten as much, just recently we got a client $500,000 of working capital, right? Now, granted, he's a business that's been in operations and he's reporting 6-figure profits. So he qualifies for that much and can afford it. Most startups are going to be limited to somewhere around 6 months of your projections of certain line items, of payroll, of inventory, of like cost of goods. That's kind of what you'll get that for. Most lenders also have a calculation if you're a company already in business, they'll have a calculation that says based on this much top line revenue, this is the max amount of working capital I would allow a business of this type to receive. So you have both of those working, right? Like, oh yeah, man, because I can dive. We could go as deep as you want.
A little deeper would be like, so on top of that, is there any type of personal funds because you still have personal bills that you have?
No, so if we go to SBA, that is a hard no and actually against the rules of the program. So when it's SBA, you cannot pay any personal debts, even if that personal debt was acquired to start your business. So like I'll give you a perfect example. This is a live cut. So again, I'll keep names out of it, but I told you we represent NFL players. We have an NFL player that's a partner in a business, and they used a personal credit to get it done, right? So now what we need to do is we can't pay that with SBA. So we either have to have a loan that's under the business that could be paid, or what we do is we have an operating company that we say, okay, here's how we're going to structure it out and build out as working capital to try and figure out, can we show a story that would get us enough working capital to make that happen?
So it's something like just paying yourself a salary through the company.
Technically, it's allowed. It is so highly frowned upon. I haven't got a deal done that has it on the projections. We'll pay your employees where others, but most of the time, now here's the thing though, what you can do, like I helped someone that we didn't put it on that they were going to pay themselves. We just built up as big of a slush pool as we could for marketing, advertising, things like that. You get that all on day one. Now, what you do with that money is entirely up to you. There are rules, right? You can pay yourself a salary with loan proceeds, but you can't pay personal debts, right? So you would have to like pay yourself some salary and then use your salary to pay that personal debt, right? Now, here's where that's going to come into play. If it wasn't what you told the lender you were going to do and you repay the lender, cool. Nobody cares. You know what a lender never does for people who make payments? Ask them why you paying me. We already agreed to this. You do I already did what I did, right? I'm the lender. I did what I did. You do what you're doing and we're good. odds are I'll probably never even ask anything of you. If you just keep doing what you do, I ain't going to check, I ain't going to tell. So because of that, I have had borrowers that have told me what they want to use the money for that may or may not be in line. And so you have to identify, can we do this or not, right? Now, here's the danger of doing something like that. Let's say you use money for non-SBA approved purposes, paying yourself, paying a personal debt, buying a personal property, right? There's tons of stuff that's happening from it. Guess what the IRS just started doing last week? If you got a PPP and you are not paying it back, you are now, your Social Security check just got 15% lighter when you received it. Like your last one, you had no heads up, you didn't know it, right? Here's what you're doing if you decide to play this game. The SBA is a government entity. If you do not repay them and they research into it, you will repay them. I want to say that again. You will repay them, whether you like it or not, because guess who they refer you to? The best debt collector in the land. You know who that is? IRS. So there are people right now that are getting IRS taxes, tax liens, people getting arrested, criminally charged, going to jail for fraud, defrauding the SBA. So if you choose as a borrower to misrepresent yourself to a lender and use the money in a way that is not allowed and you don't repay and you get caught, there are consequences. Also, that means you can never get another government loan in your life. That means a personal mortgage, FHA, right? You got to go through the conventional one. Good luck getting a non-Fannie Mae, Freddie Mac mortgage. Like that's hard for well-qualified people, right? Like every mortgage is government regulated. That's right. So when you think about that, you got to understand the gravity. Now this is SBA lending, right? SBA lending is government backed. So you can put in things for structure, payroll, marketing, advertise, and as long as you repay it, you know, that's, I hope I've explained the risk to you there, right? Like I can't make that decision for you. And I know plenty of entrepreneurs go one way or the other, and neither is wrong.
Building on his question, even if you can't like pay yourself from the loan, which is a huge no-no.
Yep.
The purpose of the loan is to increase revenue, and so as long as you pay the loan back, you can pay yourself from the increase.
Oh, absolutely, yeah. Okay. So, like for instance, I have one client that he's a very successful insurance agent, right? He carries MCAs and he has no reason to. He'll go get an MCA loan when he's got 50 grand sitting in his bank because he's like, sorry, I have less than 70, and if I don't have 70, I don't feel comfortable in life. That's how people operate and how people operate. So whatever you need to be comfortable, cool. That's what lending facilities can be there for you, right? So in his case, he has some plans for the money. A lot of it is growth, right? And he'll double his revenues, but he had some other plans for some of that money as well. But the point of being, he can easily repay this. So in that case, you take the loan, you put it in there, you start spending it out, and then you just pay yourself your distributions as you normally would. And as those distributions accumulate in your personal account, then you do that, right? There is absolutely, like, now lenders, don't get me wrong, they don't say you can never pay yourself, right? They don't want to loan you to pay yourself back, right? And that's the verbiage in the SBA rule is something to that degree. It's like, you can't use our funds to recoup your own investment or to pay yourself back from the business investment. It's got to be used to further substantiate the company, right? But yeah, if your revenues are increasing, there's nothing wrong with that. Like on a lot of them, what we'll typically do is we'll say, hey, let's put on this projection that you're not going to pay yourself for the first 6 months. Because when you run the financial projections, I need it to cash flow in an appropriate basis. And when you pay yourself as an owner in those first 6 to 12 months, one of two things happen. One, the projections don't cash flow anymore, right? Or two, your projections aren't realistic anymore because now they cash flow. And sorry, like you're just not going to make as much money the first month you think. I'm with an existing restaurateur that has a 2-hour wait at our location, right? We were very naive in opening up a new location. We didn't think we'd have to do, so we were very minimalistic in marketing. It took us 3 months to get to break even. Guess what? 3 months break even in a restaurant is magical. We're still a freaking unicorn, right? Most restaurants are not even approaching break even until 12 to 18 months. A lender wants to see you break even at 12 months. And that meaning not only break even with the extra to make this repayment, right? So to the idea of what I was saying, absolutely, right? Like you just got to do it appropriately. Just like when I was here on last Saturday, they talked about the commingling and stuff like that, right? There's nothing wrong with paying yourself a salary, right? but don't pay your personal cell phone or your personal car bill out of your business account. Like, do what I do every month. I like what, as soon as that money come in, I'm like, cool. As soon as there's a certain amount, I just transfer this much out. So I know I always have this much in my business account. And anytime it's over that, within like, I think I do it on like second Friday or something, like whatever it's over, owner draw, bam, just goes out to me, right? And then that way, when it's in my personal account, I can do whatever I want. Now, if I go get a $100,000 SBA loan and I go, bam, $50,000 payment to myself, doesn't matter what it's for. What does it look like, right? Then it's going to go to that whole HR rule. It doesn't matter what happens. It's what you can prove. And on paper, that looks like you took an SBA loan and gave yourself $50K. You're going to get in trouble for that, right? If that same $50K sat there and did nothing, and you went and got a payroll provider and paid yourself $5,000 a week for the next 10 weeks, now they'd say, hey, this person was paying themselves a salary. Perception sometimes can be a large portion of this, right? So it's about playing the rules appropriately. But I say it is, and also have an open conversation with your lender, because realistically, they don't want a loan to pay you back either, because that's not in the best interest of the business. I mean, I get it. It's in the best interest of you personally, right? Like I'm working with someone right now that I was talking about SBA and we think we have a small deal, but I really like his business and I think it'd be good for one of our NFL clients. So we just had the phone call today that we're flipping to investment instead, right? So we can help look at things like that for individuals as well when it makes sense. But like, to give you an idea, this person is doing 60,000 in revenue on their third month. They opened the doors, did 30. The next month they did 50, right? Those are the type of deals that I can get an investor instantly attracted on, right? Like otherwise, like restaurant, like, I mean, I've tasted your food and I know you've got something, and you also are very vegan. And so you're niche. So there's things going that can work with it, but you got to understand, this is the major leagues here, bro. Like everybody's got a restaurant in Vegas and they're all 5 stars. And like, you know what I mean? So like, this isn't like a normal city where you can just have good food and good service and make a killing, right? Like good food and good service you can play now. Congratulations. You get a ticket to come into the game, right? Because this is Vegas. So you've got to have something different, whether like for instance, I'm following 303 in the cut on social media just because I love what they're doing. And I see the line when I drive home. So I'm like, dude, and they're a food truck that's only open like 4 or 5 hours a day. And I guarantee you they're killing most other businesses, right? So it's like, they've got something different. And you know what? They just pile all kinds of crap on fries and in burritos, bro. It's like, in my opinion, it's the whole gimmicky food thing that we've seen now. Like, you guys know how that's like, people are making food that is just like this combination of all this craziness. It's more gimmick than, right? But people love the flavors. But the point of the matter is it doesn't matter why they're there. You got whatever it takes to get the people's attention that you know need your goods or services. How do I do that in the most effective way? They've found the sauce for that. How do I do that? I teach you about what's going on in this world, right? How do we do that business line? So what other questions do we have? Done? Awesome. So just want to say thanks again, guys. My name's Steven Ness. You'll see me doing all kinds of different kinds of events. Stay connected with Promise Startups. We're going to start blasting out some of the events we're doing in 2 weeks. That'll be all around telling your story, going to give you guys tools, capabilities to actually craft a great business plan that'll actually be compelling to a lender versus just what we all think they want to hear, right?